Welcome to the Deep Dive, the show where we slice through the noise and uncover the surprising facts and crucial insights you need. Today, we're plunging into a really fascinating puzzle, Castellum Inc., ticker CTM. Now, on one hand, you have analysts pretty much screaming strong buy, right? They're predicting massive upside. They see this deeply undervalued national security asset, on the verge of a major turnaround. But here's the kicker. The company's own insiders seem to be selling shares hand over fist. So, which story is true? Is Castellum really poised for explosive growth? Or is it maybe a high-risk microcap that's just destined to struggle? We're going to pull back the curtain today on this stark contradiction. We'll explore everything from their core business to their financials and, maybe most importantly, what that insider selling really means.
That's right. And just for context, for this deep dive, all our data is anchored to September 5, 2025. Castellum's share price at market close on September 4th was $1.08. Our mission today is really to dissect its business, scrutinize the leadership, evaluate its financial health, gauge the market sentiment, understand who owns it, and meticulously map out all the associated risks. By the end, you should have a really comprehensive understanding of exactly where this company stands and maybe what to make of that intriguing contradiction you mentioned.
All right, let's jump right on then. Part 1, the foundation, business, management, and financials. Chapter 1, business analysis. Okay, let's start right at the beginning. What exactly is Castellum Inc.? What do they do for the U.S. government, and how do they actually make their money?
Right. So at its heart, Castellum is a technology company, but, and this is key, it's not manufacturing physical goods, like hardware. They're focused on solving critical national security challenges for the U.S. federal government, operating exclusively in the, let's call it, the digital domain. Think cutting-edge expertise, software, cyber, not factory floors.
Okay, digital domain. Got it. But how does this specialized digital expertise translate into actual cash flow? And what does their revenue model tell us about the kinds of risks they're taking on?
Well, that's immediately crucial about Castellum's revenue model, based on their 2024 filings, is just how stable or maybe defensive it is. A staggering 94% of their revenue comes from what are generally considered low-risk government contracts. You've got time and materials, T&M, making up 55%, and cost plus fixed fee, CPFF, at 39%.
Okay, wait. T&M, CPFF. What's the key difference there for risk?
Good question. With T&M, they're basically paid for the hours they work and the materials they use. So if there are delays, the risk generally shifts to the government, not Castellum. CPFF contracts are similar in that their costs are reimbursed, plus they get a guaranteed fixed profit. It's very common for R&D type work. Again, low risk for Castellum. Only about 6% comes from firm fixed price FFP contracts. That's where they do bear the risk if costs run over.
So 94% of those safer contract types.
Exactly. That concentration means they have a highly defensive, predictable revenue stream, excellent visibility into future earnings, probably. But there's a flip side. It inherently caps their profit potential. They're kind of built for steady, reliable work, maybe not explosive, high-margin projects.
Okay, so they're playing it safe on contract risk. That sounds good on the surface, but stability sometimes comes with other risks, right? Like, how reliant are they on just a few big government clients? Is their concentration risk?
You're absolutely right to ask that. And yes, this is a significant point of concern. Their top 3 contracts accounted for a huge 49% of their 2024 revenue. Now, these are major long-standing agreements with big players like Nevadair and Nevacia, which definitely shows trust and deep relationships. But yeah, that kind of high customer concentration is undeniably a notable risk, especially for a company of Castellum's size.
Nearly half their revenue from just 3 places.
Okay.
So given that, what specific services are they actually offering? What's their bread and butter in this high-stakes digital defense world?
Their services are really about the invisible but absolutely indispensable infrastructure of modern warfare and intelligence. Their core is cybersecurity and information warfare. That means protecting critical networks, doing intelligence analysis, executing both defensive and sometimes offensive cyber operations. They're also heavily involved in software development and systems engineering, building enterprise applications, crucial mission planning tools. They've got specialized expertise in electronic warfare, EW, especially for the Army, apparently, and they help clients with sophisticated data analytics. Finally, a big chunk is C4ISR support. That's command, control, communications, computers, intelligence, surveillance, and reconnaissance. Basically building and maintaining the entire nervous system of military operations. Intangible stuff, but absolutely vital.
They sound crucial, yeah. but we're talking about a massive trillion-dollar global IT services market.
Yeah.
How does Castellum, a microcap with what, around $107 million market cap and only 238 employees, how do they really compete against the giants in that space?
Yeah, that's the classic dual-edged sword of their scale, isn't it? Being a microcap definitely means they face risks from limited resources. However, it also means that a single significant contract win can lead to potentially explosive growth for them. Think about that $103.3 million Neva Air award they won. For Castellum, that's career-defining. For one of the giant defense primes, it might barely register, maybe just a rounding error.
Okay, so what's their secret sauce then? What gives Castellum its primary value proposition? What allows them to carve out a niche against competitors who are just vastly larger?
Right. Here's Castellum's, well, you could almost call it their superpower. It's their collective human capital. Get this. 94% of their employees hold government security clearances. And these aren't just any employees. 56% have STEM degrees and 29% hold advanced degrees. Now, obtaining and maintaining these security clearances is incredibly difficult. It's time-consuming, and it's very expensive. This isn't just, a badge they wear. It creates a formidable moat, a barrier to entry so high that many larger commercial IT firms simply cannot compete for these highly sensitive government contracts. They need that specialized, cleared workforce. Castellum operates in a world few others can even access.
Wow, 94% cleared. That is a powerful advantage. Okay, zooming out a bit, what broader industry trends are fueling the demand for Castellum's very specialized services? Are they swimming with the tide?
Oh, absolutely. Castellum is operating in a sector with incredibly powerful long-term industry tailwinds. The overall global IT services market, projected to grow at a healthy 7.2 to 9.4% CAGR through 2032. But cybersecurity, which is Castellum's core, that's expanding even faster. Why? Well, factors like global digital transformation, a rapidly rising threat landscape, the double-edged sword of AI adoption, and crucially, this widespread shift towards zero-trust architecture. That's a security model based on never trust, always verify, right? Regardless of where you are or what device you're using. A recent 2025 report found that 81% of organizations plan to implement zero-trust strategies. That's a huge demand driver for exactly what Castellum does.
Okay, this seems like a great moment to remind you, if you're finding this kind of in-depth analysis valuable, please do like and subscribe to stockanalytics.ai on YouTube. Your support really helps us bring you more deep dives like this one.
And on the competitive landscape, well, as you might imagine, it's intensely competitive, highly fragmented too. Castellum finds itself competing not just with direct microcap peers, maybe like Research Solutions or WidePoint, but also against those massive defense primes. They obviously can't compete on scale, so their strategy has to be winning on niche expertise, leveraging those cleared personnel, being agile, and relying on those deep, established relationships within specific government agencies.
What about the regulatory environment? All those government rules and compliance hoops.
Yeah.
Does that intricate web help or hinder a specialized company like Castellum?
It's interesting because in this case, the highly regulated nature of U.S. government contracting, the complex federal acquisition regulations, FAR, cost accounting standards, really stringent cybersecurity protocols, it actually acts as a significant barrier to entry. So it helps Castellum by making it incredibly difficult for new, less experienced players to just jump into the market. Plus, you have global regulatory trends like the EU's NIS2 directive or new SEC disclosure rules, which are a net positive. They basically mandate increased cybersecurity spending across the board, driving demand directly for Castellum services.
And for those of you who are members, remember, if this deep dive sparks ideas for other companies you'd like us to explore, you can always drop your suggestions in the comments. We absolutely prioritize those member suggestions for future episodes.
So just to quickly summarize Castellum's kind of core advantages and the hurdles they face. Those unique barriers to entry. It's that security-cleared workforce, number one. Then their established government relationships and past performance history, and the sheer complexity of the bidding process itself. On competitive advantages, okay, they might have limited brand recognition, no significant cost advantages, but those moderate switching costs, and especially that unique asset of highly skilled, cleared employees, that creates a durable, maybe not insurmountable, but a durable edge in their specific market niche.
Chapter 2. Management evaluation. Okay, we've established what Castellum does, the unique niche they fill. But a turnaround story always comes back to leadership. Who's in charge now, and are they truly the right captain to steer this ship out of what sounds like some pretty turbulent waters?
Yeah, the current story really kicks off with CEO Glenn R. Ives. He took the helm on July 1st, 2024. And this marked a really decisive strategic pivot for the company. You see, the period before him, say 2019 to 2022, that was what you could call phase one. It was all about aggressive growth. Through acquisitions, they did 7 of them. Now, that did grow revenue, absolutely. But it also piled on complexity, a lot of debt, and led to persistent unprofitability. Under Ives, this is phase 2. The focus is squarely on organic growth, operational efficiency, and crucially, repairing the balance sheet. And his early successes, well, they're undeniably notable. He's raised over $16 million in capital. He's aggressively slashed long-term debt down to under $5 million. And maybe most importantly, he secured that landmark $103.3 million Navarre Prime contract. Winning a prime contract of that magnitude, that's a powerful signal. It suggests a new level of trust from the government and really validates this new leadership's operational focus.
That's a very clear change in direction. How transparent and maybe ethical does this new management team seem with their communication? To shareholders, to the market?
Their communication seems pretty solid, especially considering they're a microcap. They issue press releases regularly. CEO Glenn Ives published a really comprehensive letter to shareholders, openly detailing the strategic shift. That level of directness is generally a positive sign, and honestly, there are no apparent ethical red flags jumping out from their communications.
Okay, so with this new strategy, how are they allocating their capital? Are they spending it wisely, building for the future?
Yeah, there's been a dramatic and, it seems, purposeful shift in capital allocation, moving away from the M&A that defined phase 1 straight towards organic growth. Recent capital raises, like that $5 million public offering in June 2025, or the $4.5 million they got from warrant exercises in August 2025, were explicitly earmarked for working capital and funding that organic growth push. They've also made a strategic investment, setting up a new subsidiary called Castellum Advanced Technology Products, CATP. The aim there seems to be developing higher margin proprietary products, moving up the value chain a bit.
What about returning value directly to shareholders? Are they paying dividends, buying back stock, anything like that?
Nope, Castellum does not pay dividends, and they have no history of share buybacks. And frankly, that's entirely appropriate for a growth-focused company, especially one that's actively in a turnaround phase.
Yeah.
All the available capital right now is being plowed back into the business to fund that growth strategy and hopefully achieve profitability.
Right. A crucial measure for any business's efficiency is return on invested capital, ROIC. How has Castellum performed here? Especially under this new leadership, are we seeing improvements?
Well, historically, Castellum's ROIC has been consistently and deeply negative. We're talking ranges from negative 9.98% up to negative 18.4% on a trailing 12-month basis. This directly reflects that long history of unprofitability we mentioned. The entire bull case, really, and the ultimate measure of this new management's success hinges on their ability to reverse this trend. They have to achieve a positive ROIC to signal that they're effectively creating value from the capital they're employing. That's the goal.
Chapter 3. Financial analysis. Okay, let's dive into the hard numbers now. What does their market capitalization tell us about their size and, I guess, the risk profile for investors looking at this?
So with a market cap around $100.72 million, Castellum is firmly planted in the microcap segment of the market. Now, that category inherently implies higher risk. You're likely to see increased stock volatility compared to larger companies. However, it also means there's significant potential for, exponential growth if their strategy actually succeeds. It's a classic high-risk, high-reward kind of proposition.
And how has their revenue picture looked over, say, the last 5 years? What's been driving those changes we talked about earlier?
Well, their revenue has seen pretty substantial growth looking back, from $13.3 million back in 2020 up to $44.8 million in 2024. But as we discussed, that growth was primarily fueled by their aggressive phase 1 acquisition strategy. There was a slight dip in 2024, but, and this is a key milestone under the new management, they achieved their first year-over-year organic revenue growth in Q1 of 2025. That's exactly what Ives is focused on. Their trailing 12-month TTM revenue now stands at $47.60 million.
Growth is great, sure. But are they actually making money? What do the profit margins tell us? This seems critical.
It is critical, and it's a mixed bag here. While their gross margin is actually quite healthy and stable, typically hovering around 39% to 41%, which indicates their core service delivery is profitable. Their operating and net margins have been consistently and significantly negative. Just to give you the numbers, their TTM operating margin is negative 10.24%, and the net margin is a negative 11.59%. This disconnect, strong gross margins but deeply negative operating margins, is primarily due to high selling, general, and administrative SG&A expenses. Basically, the company's overhead. The new CEO's cost discipline initiatives are directly aimed at tackling this exact problem.
Okay, high overhead dragging down profits. What about cash flow? Is the business actually generating cash after all expenses, or are they burning through it?
Their free cash flow, or FCF generation, well, it's been volatile and frankly unreliable. Currently, it's sitting at a negative $2.04 million on a trailing 12-month basis. This cash burn obviously isn't sustainable in the long term. Achieving sustained positive free cash flow is absolutely a pivotal goal for their entire turnaround strategy. They need to stop bleeding cash.
Right. Beyond those specific margins and cash flow, what about overall earnings stability? Have they ever been consistently profitable?
No, not really. Castellum has a long and quite consistent record of unprofitability. They've reported annual net losses every year, ranging from negative $2.7 million back in 2020 up to negative $10.0 million in 2024. This really underscores the point that an investment here is purely a forward-looking bet. It's a bet on a new era of profitability under new management, not one based on any kind of stable, proven track record of making money.
Okay, let's turn to the balance sheet then. How much debt are they carrying now, and what's their liquidity situation look like? Is there improvement here?
Yes, this is definitely where the new management's efforts show the most dramatic results. Their debt-to-equity ratio has seen a huge improvement. It plummeted from 0.92 in 2023 down to a much more conservative 0.17 currently. That's significant deleveraging, mostly thanks to those recent equity raises. It's greatly reduced their financial risk profile. Additionally, their current ratio is exceptionally strong at 3.62. That indicates very robust liquidity, primarily because they have a healthy $14.73 million cash balance sitting there. This really mitigates any near-term liquidity concerns, and as we mentioned, dividend stability isn't really applicable. They're reinvesting everything for growth.
With the company in such a unique turnaround situation, how do we even begin to value it? Can we rely on the usual methods, PE, PSO?
Well, traditional price-to-earnings PE ratios are out the window simply because they have negative earnings, can't divide by 0 or less. So we look at price-to-sales, PS, that's currently around 2.1x their trailing 12-month revenue. Now, compared to maybe some other microcap peers, that might seem a little expensive. Maybe peers trade around 1.4x, but it's actually quite reasonable when you compare it against the broader US IT industry average, which is around 2.3x. What this suggests is that the market is already pricing in some expectation of a successful turnaround. It's not valued like a company expected to fail. But here's where it gets truly fascinating and really central to the whole Castellum debate. The enormous gap you find if you try to do an intrinsic valuation, like a discounted cash flow DCF model. If you build a conservative DCF, factoring in their history of losses and maybe cautious future projections, you might estimate a value as low as, say, 0.32 per share, maybe even less. This stands in just stark contrast to Wall Street analysts who, as we'll discuss more, are averaging around $3 per share. They're clearly projecting a highly successful turnaround. For a bullish DCF model to even get close to those analyst targets, you'd need some pretty aggressive, though maybe plausible, assumptions. Sustain 10.2% annual revenue growth, a rapid and significant shift to positive free cash flow, dramatically improve operating margins, and even then you'd probably use a high discount rate, maybe 15-20% because of all the inherent risk.
Wow, okay. So less than 50 cents versus $3. That's an incredible valuation, Kath. It really just underscores the speculative nature of this whole thing right now, doesn't it? All right, let's shift gears now and look at the bigger picture. Part 2, the horizon market, ownership, risk, and conclusion. Chapter 4, market sentiment. So after all that, what does the market actually think about Castellum right now? What's Wall Street saying? What's the general buzz?
Well, the sentiment coming from Wall Street analysts is, frankly, overwhelmingly positive. We're looking at a consensus strong buy rating. The average one-year price target is quite striking, $3. The range reported spans from about $2.08 up to $3.15. Now, compared to the current share price of $1.08, this implies over 175% potential upside. So clearly, the analysts covering the stock are very confident in the successful execution of this turnaround story.
And what kind of news has been fueling that optimism? Is there a consistent narrative coming from the company itself or from media coverage?
Yeah, the news flow throughout 2025 has been pretty much uniformly positive. It's consistently reinforcing that turnaround narrative we've been discussing. We've seen announcements of record quarterly revenue, clear signs of improving profitability metrics, that significant debt reduction we talked about, the huge landmark $103.3 million Naviar contract win, and strategic initiatives like launching their new tech subsidiary, CATP. All of this supports the idea that the company is indeed moving in the right direction, or at least communicating that effectively.
Are there any other market indicators maybe telling us about broader investor sentiment? Like, are a lot of people betting against the stock? What about short interest?
Good point. Short interest is actually quite low, running at just 2.13% of the float. This suggests there isn't significant organized skepticism, not a large number of investors actively betting big against the stock's success. Looking quickly at technicals, the stock price at $1.08 is currently trading slightly below its 50-day simple moving average, which is around $1.17. That might indicate a recent cooling of short-term momentum. However, it is trading above its 200-day SMA, which is around $1.98. That's generally considered a more bullish long-term signal, suggesting the broader underlying trend might still be upward despite recent dips.
Chapter 5. Ownership structure. Okay, who actually owns Castellum? And what insights can we maybe glean from that ownership breakdown about its potential future?
Well, institutional ownership is relatively low. It typically ranges somewhere between 7.4% and 8.1% of the outstanding shares. What that means is Castellum is largely, you could say, undiscovered by the big institutional money, the pension funds, the large mutual funds, etc. Now, this is kind of a double-edged sword. On one hand, it represents a potentially significant pool of future buying power if the turnaround really succeeds and they start attracting that institutional attention. But on the other hand, it also indicates a current hesitation from those larger, perhaps more sophisticated investors, likely due to the company's size, its trading liquidity, or that perceived risk profile we've discussed. Conversely, insider holdings are quite high, somewhere between 20.1% and 23.5%. Usually that's seen as a positive, signaling strong alignment between management's interests and shareholders.
Okay, here's where it gets really interesting and frankly a bit unsettling, as you hinted earlier. You mentioned this contradiction between analyst optimism and what insiders are doing. What do the transactions actually tell us compared to all the positive public statements?
Yes, this is perhaps the single most significant red flag in the entire Castellum story, and it really throws a huge question mark over that whole bullish narrative. Despite all the positive news flow, despite those glowing analyst reports and strong buy ratings, recent insider transactions have been overwhelmingly negative. Just look at the last 3 months. There have been 6 insider sales reported and 0 open market buys. 0. Now, zoom out to the last 12 months. Insiders have sold, on net, over 2.27 million shares. This stark contradiction, public optimism versus private selling, it's a major, major cause for concern. It strongly suggests that the people who arguably know the company best might not share the same level of long-term confidence that their public statements or the analyst project.
Wait, hold on. Let me make sure I heard that right. Analysts are screaming strong buy with over 175% implied upside. The company's putting out press release after press release about good news, but the people running the company, the insiders, are consistently overwhelmingly dumping their shares. How does that even compute? That's a massive disconnect.
Right.
Why isn't that sending bigger alarm bells ringing across the market?
It absolutely should be sending alarm bells, you're right. The market, especially for smaller, less followed microcaps, can sometimes be slow to process these kinds of contradictions. Liquidity is lower, fewer eyes are on it. It's a classic case where, arguably, actions speak louder than words. Now, okay, there could always be personal reasons for insiders to sell: stock diversification, taxes, buying a house, whatever. But such a consistent, one-sided pattern of net sales, especially happening after recent capital raises supposedly shored up the company, it directly undermines the credibility of the bullish turnaround narrative for many cautious investors. It implies, at the very least, a potential lack of conviction from within the company itself about the near-term prospects or valuation compared to what external analysts are seeing or projecting.
Okay, so how concentrated is the ownership overall then, and what are the implications of that, especially with all this insider selling layered on top?
Well, the ownership is quite concentrated among those insiders who are selling and also retail investors. There's that notable lack of a large, potentially stabilizing institutional investor base. This concentration, particularly combined with ongoing insider selling pressure, can definitely lead to higher stock price volatility. Swings could be more pronounced. And we also need to acknowledge the significant shareholder dilution that's occurred. Shares outstanding grew by a hefty 68.4%, mostly from those recent capital raises needed to fix the balance sheet and fund operations. This just means the existing shareholder pie has been cut into many, many more slices. Each existing share represents a smaller piece of the company.
Chapter 6, Risk Assessment. All right, now for the really critical part. Let's try to break down the core strengths, weaknesses, opportunities, and threats for Castellum in a clear way. A SWOT analysis, essentially.
Okay, let's do a SWOT for strengths. Number one has to be their elite human capital, that highly skilled, security-cleared workforce. It's a huge barrier to entry. They also have established government relationships with key agencies like NAVAIR and NAFISA. Their defensive revenue model, being heavily reliant on those low-risk T&M and CPFF contracts, provides a stable base even if it cacks upside. And you have to acknowledge the potential of the turnaround leadership under Glenn Ives, given his early, tangible successes. Now, for weaknesses. Top of the list is that clear, consistent history of unprofitability. There's also the high customer concentration, with 49% of revenue tied to just 3 contracts, very risky. Their lack of scale as a microcap means fewer resources compared to competitors, and historically they've carried a high overhead structure, especially in SG&A, which has dragged down profitability. Looking at opportunities, they are definitely positioned to benefit from those favorable industry tailwinds in cybersecurity and digital transformation. There's significant potential for prime contractor growth, building on that big NAVAIR win. There's a real chance for institutional discovery if they execute well. Big investors might start noticing them, driving demand for the stock. And their new CATP subsidiary offers potential value chain expansion into possibly higher margin proprietary products. Finally, the threats. These are substantial. They face intense competition in the crowded government contracting space. There's always inherent government budget or exactly funding priorities can shift. Most notably, as we've hammered home, that insider selling pressure remains a significant near-term threat that could really cap the stock's performance, regardless of fundamentals. And of course, talent retention is a constant challenge. Losing those key cleared employees would be devastating, as they are the core asset.
How do the broader economic forces, things like inflation and interest rates, factor into Castellum's risk profile right now?
Inflation definitely poses a threat, particularly to that small 6% slice of firm fixed price contracts where rising costs can't be passed on easily. More broadly, rising labor costs for their highly skilled workforce could pressure margins across all contract types, even T&M and CPFF, if the contract rates don't adjust quickly enough to keep pace. Labor is their biggest cost. For interest rates, the direct impact is probably less severe now that they've significantly deleveraged the balance sheet. That was a smart move. However, prolonged high interest rates could indirectly lead to tighter federal budgets down the line, potentially reducing overall government spending on contractors across the board. It's more of an indirect risk now.
And what about geopolitical factors? We hear so much about global tensions. Do those ultimately help or hurt a national security contractor like Castellum?
Generally, geopolitical factors present a clear tailwind for a company like Castellum. Heightened geopolitical tensions, think about the US-China competition. Ongoing global conflicts, these directly drive increased defense spending by governments. That, in turn, creates greater demand for Castellum's highly specialized cybersecurity and intelligence support services. The main risk on this front is maybe less direct. If conflicts really escalate, it could lead to broader supply chain disruptions or just general economic uncertainty, which could indirectly affect even service companies like Castellum. While direct tariff impacts would likely be minimal for a service provider, the overall economic climate always matters.
Chapter 7, Conclusion. All right, let's bring it all together. What does this all mean? Let's clearly lay out the bull case versus the bear case for Castellum.
Okay, the bull case. It really rests on a few key pillars. First, you've got the new captain at the helm, Glenn Ives. His decisive strategic pivot, his focus on organic growth, those early successes in fixing the balance sheet and winning that huge NAVAIR contract, that's all very compelling. Second, they're benefiting from a rising tide, operating in sectors like cybersecurity and defense IT with strong, long-term secular tailwinds. Demand should grow. Third, they've arguably become a cleaner, de-risked ship. The balance sheet is much improved, debt is way down, cash position is strong, less financial risk than before. And finally, the potential payoff. If this turnaround is successfully executed, the stock could represent deeply undervalued potential, at least according to those aggressive analyst price targets suggesting massive upside. But the bear case is equally strong, and you absolutely cannot ignore it. First, there's that undeniable long history of losses. Consistent unprofitability offers zero guarantee the new strategy will actually succeed where past ones failed. Second, and critically, is that stark reality that actions speak louder than words. The heavy, persistent, one-sided insider selling directly contradicts the public optimism and the glowing analyst calls. That's a huge red flag. And finally, Castellum faces all the challenges of microcap mayhem, intense competition, high customer concentration risk, and the inherent stock volatility that comes with being small, all of which significantly amplify the investment risk.
Let's just quickly revisit that valuation point. What's the actual range we're looking at again, and where does the current share price of $1.08 really sit within that huge spread?
Yeah, that wide valuation gap is precisely the heart of the dilemma here. A conservative, discounted cash flow model, one grounded more in historical performance and cautious projections, might suggest an intrinsic value of less than $50 per share, maybe significantly less. Yet Wall Street analysts, looking forward and assuming success, boldly project $3 or even more. The current $1.08 share price sits smack dab in the middle of this enormous chasm. It's a clear reflection of the market trying to balance Castellum's troubled past against its potentially bright future, factoring in all the significant uncertainty and execution risk that surrounds it.
So after all that, what does this really mean for you, the listener, as you perhaps ponder an investment in Castellum Inc.?
Ultimately, I think an investment in Castellum today at around $1.08 has to be seen as a deeply speculative bet. It's a bet on the successful execution of a complex, ongoing corporate turnaround. The market, particularly through analyst sentiment, clearly shows optimism. But it also perceives, correctly I think, significant execution risk priced in. The critical question for you boils down to this. Does that bullish narrative, the story of a strategic turnaround led by a new captain, happening in a growing market, does that truly outweigh the very loud bearish signals? Signals like the long history of unprofitability and perhaps most importantly that heavy, consistent, and one-sided insider selling. This company presents a genuinely high-risk, high-reward proposition. It really demands a strong conviction in management's ability to overcome not just its difficult past, but also, maybe more worryingly, the current actions of its own executives.
Thank you for joining us on this deep dive into Castellum Inc., a truly fascinating case study.
We certainly hope this exploration has given you a clearer picture of this complex company, and especially those compelling contradictions at its core.
If you enjoyed this deep dive and found it valuable, please remember to like and subscribe to stockanalytics.ai on YouTube. It really helps us out. And for our members, it's just $4.98 a month. You get priority deep dives on tickers that you suggest. Over the next few months, we're actually planning on covering all of the S&P 500 stocks, and our members will get exclusive priority access to that content as it rolls out. Also, if you just want a one-off deep dive on a specific stock that's caught your eye, just drop us a super thanks on YouTube, and we'll prioritize getting that analysis done for you.
And as always, here's our important disclaimer. This analysis was generated by an AI system. It's intended purely for educational and informational purposes and should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions based on this or any other information.
We'll be back soon with another deep dive. Until then, stay curious and keep informed.